I'm definitely in the Jim Cramer camp in terms of looking at these rallies with a lot of suspicion. Put another way, if I'm going to be up 15%, I'd much rather have that, spread out over 6 days than over 3 days or 2 days. The sharpness of this rally, the magnitude and the sharpness and the velocity of this rally, you've only seen that kind of level of sharpness during, bear markets, whether it's in 2008 and back in the 1930s, 1931, as you were mentioning earlier, or 1933. One thing that's also very interesting is that, the VIX closed at 60 yesterday. I'd have a much easier time kind of really believing this rally is sustainable if the VIX was down below 40 or 35 or so. But the VIX is effectively telling you that there's, the average move over the next 6 weeks or so is going to be 4%. Those are not going to be all 4% up days. There will be a lot of down days there. So I think it's pretty inevitable that we're going to retest last Monday's lows, that 2,200 level, and quite possibly go beneath that. And whether we go beneath that's probably very much a function of how ugly these corona curves go, and how resoundingly bad the future economic data in the U.S. is.
Yeah, the VIX is certainly a key indicator that we all continue to watch as it does stay elevated in the 6-handle area. The dollar index, though, is also something that we should watch closely. It's down about 3% for the week here, relatively flat right now, at least last 24 hours or so. What should investors be paying attention to with regard to the dollar, especially if you're looking at companies that are doing business around the world?
Right, I think that's a great point, and I think the sort of the macro backdrop here with respect to the dollar is one of the silver linings so far. I've been arguing that right after those first 50 basis point cuts that we got back in March 6th, that the dollar was very much about the dollar. A weaker dollar eases conditions in the U.S., but it also eases conditions in emerging Asia. Those countries are not only on the front lines of Corona. These are the economies that are just rebooting, and the last thing they would need is a dollar surge. During big global crises, you typically get dollar surges. So I think this weaker dollar condition, and you're seeing that across, whether it's the Taiwan dollar, the Korean won, yen. Some of them are not super weak. I'm sorry, some of them are not, strengthening very dramatically, but the key message is not to see the dollar surge here. That's what we've been seeing here. That's very, very important. There's a lot of dollar-denominated debt in those countries that would see their borrowing costs go up a lot. But a lot of those companies in emerging Asia are integral to the U.S. supply chain. Either they're involved in the manufacturing of products or components of those products there. So and the sovereign level doesn't need to be stressed any more than they already are either, right? Every country in the world right now is looking there. We'll be having sovereign issues for some time to come, and particularly in emerging Asia, you don't want to see that happen right now.